Well, we have a bit of a quiet start for the stock market today, but generally equities have really been powering ahead. We're coming off this 8-day rally, which is getting the S&P 500 back towards its all-time highs. The TSX, as we mentioned, closed at a new record high yesterday, and investors are digesting a lot right now, including a hope for soft landing situation for the economy. Now, we got some evidence today that maybe that could be true in Canada because the inflation trends, based on what happened in July, are once again fairly encouraging. It's got the market thinking that come September, the Bank of Canada is going to cut interest rates once again. That'd be the third time they've done it in as many meetings. And then, of course, in the U.S. this week, everybody's going to be watching what Jay Powell, the head of the U.S. Federal Reserve, has to say. He is scheduled to speak from that big Jackson Hole event, which is taking place in Wyoming later this week. And remember, there's growing expectations in the market that the Fed will potentially join the Bank of Canada in the rate cutting game come September as well. Let's talk a little bit more about what the rate story looks like, how the economy is performing with Kurt Reiman. He's head of fixed income Americas at UBS Global Wealth Management. Kurt, it's great to see you. Thanks for the time.
Nice to be with you again, John.
I feel like we spend a lot of time talking about the road ahead for interest rates, but for good reasons. I mean, these are big financial matters for everybody. And what's your general sense on where we're heading at this point?
We've come a long way. Rates in the U.S. are down back below 4% again. In Canada, 10-year note yield is closer to 3%. Policy rates, as you mentioned in the outset, are moving lower. We expect that's true in both Canada and the U.S. Over the course of the rest of this year into 2025. I think there's quite a bit of volatility in financial markets. It's a result of lack of conviction in the macro economy. It was a pretty easy opportunity for investors to get scared, it seemed, back at the early part of this month, when we had the Bank of Japan and the Federal Reserve moving, it seemed, in opposite directions, which prompted a big move in the yen. And that, as everybody knows now, this yen carry trade has been unwound to a large degree, and that's affected risk assets. But there was this perception, I guess, at the beginning of the month, because of these big moves in risk assets, that we were headed towards a recession. Our view is that growth is likely to be slower, but a recession is still unlikely in our view. And this move lower in policy rates isn't the Fed or the Bank of Canada necessarily rushing to the rescue. It's more of an acknowledgement that inflation is trending in the right direction. And as long as inflation keeps moving lower and these policy rates are not moving in tandem, then policy rates just become ever more restrictive. So I think that, we got a bit of a wake-up call at the beginning of the month. Markets are settling back in, as you mentioned. The equity market is roaring back again. And we think that that's consistent with this view of policymakers moving to a less restrictive stance, inflation normalizing, and still a pretty good overall economic picture, albeit not as good as at the beginning of the year.
And I'd like to drill down specifically into the bond market, Kurt, because this is also a tricky part of the economic cycle for a lot of investors. There's a lot of pundits. They note that if interest rates are going to trend lower, there might be some yields that you can lock in with fixed income today that might not be available in the future. And on top of that, price appreciation, if you can get it in your fixed income, that's a nice thing too. It's just that fixed income on average has been a pretty volatile component of the market. We don't talk as much about that because we're always covering the daily swings in the stock market. Yeah. It's been hard to get the timing right for some investors. So what would be your overall message to fixed income investors about how to think about this current point in the cycle?
Yeah, I agree with you, John, that the bond market has been, a volatile market. We've seen rates in the U.S. move up close to 5%. Now they're back below 4%. And that often gets overshadowed by the volatility that we're seeing in the stock market. But yet the bond market has been as volatile, and it's this repricing of the economy on very low conviction about where things are headed. This data-dependent Fed, data-dependent central banks, it seems. And yes, I think that there's still very much a place for, especially at these yields, for bonds in a portfolio. But right now, when we're looking at call it just under 4% for the 10-year, this may be not the time to add to longer duration or longer maturity positions. What I'd say is that you might want to wait until yields have moved back towards a level over 4%, maybe closer to 415 to 425. That might be a better opportunity to lock in some of those higher rates that you were speaking about. But in general, fixed income, this is a place to get quality yield. Investment grade corporate bonds, for example, look to us to be a pretty decent opportunity given the fact that we don't expect a recession. There's an incremental yield advantage over treasuries. It's something that you can add to the portfolio to give a little bit more ballast in this episode of higher volatility. We like that. So right now, I would say, yeah, we're favorable on bonds. We think some of that opportunity set was eaten up by the fact that yields moved so low so quickly. But we think we're going to get to a point again where investors are going to be able to lock in some of these higher yields that are attractive. I think comparing across the border, the opportunity set in fixed income is actually quite interesting relative to the S&P 500 dividend yield, which is south of 2%. In Canada, it's interesting because we have the dividend yield on the TSX that's approximating what you're getting on the 10-year in Canada. So, when we think about asset allocation, there's a pretty interesting yield opportunity still in Canadian stocks that I think investors need to be also paying attention to.
Okay.